Hi, this is Keith Schneider, CEO of MarketGauge.com, and this is November 19th, 2017 edition of Market Outlook. So this week we're going to be introducing a premium version. So the way this is going to happen is the free edition of Market Outlook is going to go through most of the key points, and for those who want a bit more detail and some other opportunities in view of the world markets, the premium edition will cover that. So without further ado, let me get into the key salient facts about the market this week. So the first one, let's just take a look at the IWM, because that really put in a great week. That had been really dragging for quite some time. And so if we take a look at it, I'm looking at the weekly charts here. Our real motion indicator right here on IWM came right back to two key moving averages, our 50 and 200 week of real motion. You see how it stopped right at that convergence of those two moving averages and bounced nicely. So that's a really good positive sign of some good weekly rotation back into the weakest sector. What I was concerned about, of course, is that these weak sectors would, or this weak particular index would drag down the others on a sell-off. And sort of the reverse happened. And if we take a look at the daily charts, one of the things you can see is that midweek, when we had that selling pressure, actually the IWM closed back into its range, and by the next couple of days, we moved back into a bullish market phase and back over that important channel. Now, the other thing to note, we'll get into it in a moment, is that our risk off and risk on gauges are showing risk off. Although we haven't had a confirmed signal, the opportunity here is you've got an inside day pattern right at the 10-day moving average in the SPYs. You're acting actually a little bit worse in the Dow. So we haven't been able to even really attack the 10-day moving average. And actually, as you can see on our real motion, it's actually a bit weaker than it had been, certainly relative to the IWM. So inside day patterns right at the 10-day moving average in the SPY, same thing in the Q, and in the Dow, a little bit weaker. So you got three of these things here that can flip either way. And considering that the gauges now, the risk off, risk on gauges are showing some weakness, it's not a signal yet, I would be a lot more flexible in terms of taking potential shorts in these indices here that have inside days and are straddling the 10-day moving average. And of course, right now, what's looking the most bullish is the IWM, because that's recovered the most and has changed phases to a bullish phase. So that's all positive. Okay, so now let's take a look at some of the things that are happening in the key intermarket relationships. And as you can see here, we've got risk off. All of our risk gauges are showing some signs of weakness, favoring more conservative plays as opposed to just equities. So here you have the SPY versus utilities, and you can see we're trading under our black line here. So that is definitely a negative. Now, looking at the other key ratios, right, as you can see, bonds versus the S&P also showing some signs of weakness here. High yield debt definitely under a lot more pressure than some of the other intermarket relationships. And the other thing that's interesting is with the pickup in gold and some of the precious metals that I mentioned, and silver as well, the intermarket relationship between these two are showing a bit of negativity. And the same thing in wood. So you definitely have some pressure here on the intermarket relationships, but it really has to sustain for us to get a bona fide signal. And more about that in our premium version in a few minutes. So regarding sectors, what's also interesting is that our weakest sector, as you can see, or second weakest sector after energy year to date, is retail. And that finally moved into an accumulation phase. So that's really positive. And as you can see, that weakest sector really found some buyers here and improved. So look at this, up 3.8% compared to down fractionally in the S&P 500. So that's interesting, and that finding support is a real positive. Now, energy still down 3.2%, but oil, the commodity, actually doing quite a bit better. So it's interesting that that retail sector has improved. In terms of volume, which is why I'm also a bit more flexible in terms of our overall view on how to trade the markets here on a short-term basis, is to take advantage of that inside day pattern and play it whichever way it breaks out. So one of the things, let me scroll down here. Okay, so one of the things you can really see is that the volume is quite weak. We have not had an accumulation day in the S&P 500 in over 2 weeks. In fact, we've got 5 distribution days. So when you look at this, right, and as I mentioned in the text, institutional buying hard to find here, right? And in fact, we've got a distribution pattern pretty much across the board, with the exception of the NASDAQ 100, which actually hit new intraday highs last week and sort of paused right around that 10-day moving average with an inside day pattern as well. So considering the volume pattern here, I would be a bit more cautious. All right, for those that want a lot more detail, hang on and move into the premium service. If you're not a subscriber, you can always sign up online or talk to Mary, and we'll handle it directly for you. Thanks, and have a great week, and good luck with your trading.